How's everyone doing? Welcome to the Strategy Room live stream on this Saturday night, June 6th, 2026. I am your host, the banker next door, here for another action packed show on this Saturday night. We've got so much to go over this week. I've got a lot of economic numbers, jobs report, all kinds of good stuff, inflation numbers, everything coming out this week. We're going to take, to start the night off here, we're going to take a look at the real estate market, particularly the residential mortgage market. What's going on? How is the interest rates fluctuation here over the last few weeks? How is this really affecting everything? What is happening with realtors, what is happening with buyers. So we're going to talk about that a little bit. Then we're going to get into a little bit of Fed news after that. Jerome Powell gave a speech this week. We're going to get into some of the takeaways on that. Kevin Warsh hiring a couple of employees there as he comes into the Fed. We've got a lot of AI news, a lot of AI in this overall and kind of in the banking space to talk about some massive IPOs that are on the horizon here with SpaceX and Anthropic, OpenAI. Maybe we'll talk about that a little bit later on. I've got some private credit update. And then at the very end tonight, I've got a couple articles on what's going on in the automotive space. I've done a few episodes over probably the last like 3 or 4 months, focusing on the auto industry, giving just an update on what's happening with that. So I got a little bit of an update with that here toward the end this evening. But with that being said, we are going to jump into our normal activity here. We're going to take a look at the United States debt clock, as we always do here. So again, just to hit the highlights, as we always do, the U.S. national debt still floating at $39.2 trillion. That equates to debt per citizen of 114,000. That equates to debt per taxpayer of 355,000. The U.S. federal spending still at 7.1 trillion, with the U.S. federal budget deficit still rolling in at 1.654 trillion dollars. Now, defense spending still at 939 billion. Interest on the national debt, like we've said before, is now officially over $1 trillion. It's been that way for probably the last month or so. Credit card debt still sitting at $1.3 trillion, and that equates to a per holder amount of $8,339. So, and oh, I forgot. And the federal debt to GDP ratio is 121%, with the consumer debt to GDP ratio now over 100%. So again, not great numbers there. But like I said, I'd like to update that because we do come back to that chart, off and on throughout the evening here. Now, I'm trying to see if this is big enough. Let me see if maybe I should make this just a tad bit bigger here. Nah, it kind of made, all right, there we go. All right, let's go with that. Okay, so stock market was having a very nice week this week until yesterday. It had a very bad day. It kind of fell off the cliff, especially the Nasdaq. Okay, but even with that being said, stock market's still doing very good. We're still at all-time highs, but I say this, but there are some clouds on the horizon, and we'll get into those clouds as we go throughout the evening here. Now, I want to take a look at bonds here for a second, because I'm going to show you guys a chart on the 10-year treasury here in just a second, but let's take the high-level view. So the 30-year bond still hovering right at 5% at 4.9999. So still, definitely still a little bit higher than we'd like. The 10-year treasury, now this did back off a little bit. This had gone just a hair over 4.6%. This is back down to 4.522%. Still, half a percentage point higher than what we'd like it to be. Earlier this year, it was hovering around 4%. I was hoping maybe it might dip down a little bit below 4, which was kind of the sweet spot that I was looking for. But obviously, with the Iran issue, everything that has kind of happened here the last couple of months, that has skyrocketed back up to, like I said, topped over 4.6%, now hovering in at 4.522. 7-year note still at 4.3%, the 5-year note at 4.268, and the 3-year note at 4.196. Now, the 2-year note is still hovering at 4.147. That was down in the threes earlier this year, but is now up to over 4.1%. And then, as I had noted with the short-term T-bills, the 1 year, the 6 month, the 3 month, the 1 month, they were all trading in this extremely tight bandwidth, right around 3.6%. That has separated a little bit. Like the 1 year T-bill has gone up to 3.839. The 6 month is at 3.795. 3 month is at 3.718, and the 1 month is now at 3.67. So a little bit of a spread, beginning to kind of returning a little bit to normal. I guess you could look at it from that perspective. So, but okay, let's look at, now let's skip over currencies for a minute. Let's go to commodities for a second here. So crude oil futures and Brent crude oil futures have both come down. May not feel like it, but they have come down. Crude oil futures are now back down to $90.25, whereas Brent crude futures are back down to $92.78. Hopefully, they continue in that direction, but I would say that in order for that to continue downward, we would need to see some kind of deal with Iran. I think we would need to see some kind of deal with Iran, and we would need to see some type of progress made with the Strait of Hormuz. Is that opening up? Are we beginning to see, tankers moving through the strait on a normal clip once again? I think that is what we really need to see in order for these crude oil futures to continue coming down. And obviously, the longer we go without a deal, the more chance that this will continue to fluctuate and head back up yet again. So, but like I said, a little bit of good news as these numbers did come down this week, which was good. Now the question is, will they continue that path? So, okay, now wanted to show everybody this chart here for a minute. Just wanted to point this out. So this is a chart from the Fred Index. The St. Louis Federal Reserve Bank has what's called the Fred Index. Or data, I should say, not the index, the database. So I found this, I've got this chart pulled up here. This is the 10-year Treasury yield. And I just wanted to show everybody here this for a second. I like to show these things from time to time just to show kind of the bandwidth of what we're dealing here. So basically 2021, we were down here at, just about 1%. And obviously, this is right before interest. We have the pandemic. Interest rates come way back down, get back to zero. And now we start to come back up here. And then obviously 22 into 23 is when we had the interest rate spikes. And you can see here, we just go straight all the way up here. We go from about 1% all the way up to 4.83% on October 24th of 2023. And now, we're not quite 3 years there yet, probably in a little bit more than 2.5 years, though. So we have been trading in this bandwidth here, basically between a high of basically 4.93 and where we find ourselves today here at around, 4.5, just about. So again, this has been the kind of normal bandwidth that we found ourselves. We have had a couple plunges here. Like on September of 2024, we got down to 3.66%. Like I said, here in February 26, we got down basically right at 4%. So we have come down a little bit, but it's always come right back up. And so we have been, constantly trending in. If you look at this 1 year here, you can see that basically we've been trading in this, 4% to, 4.6. We had a top here of 4.67%. So this is basically the bandwidth that we've been trading here throughout the year. So I just wanted to show that the last basically about 3 years, it hasn't really changed all that much, and that was really the kind of thing that was really what I was trying to point out to everybody here. It's just that, like, you might want to see the 4.5, 4.6%. Some people might freak out a little bit and be like, oh my gosh, this is now it's driving residential mortgage rates back up and all that. But again, I just wanted to point out here, sometimes it's helpful to look at some of these charts and just realize that, the bandwidth of where you're trading at is not, it's not really all that far off. We're not really all that far off from where we've been over the last 3 years. I think that the disappointing thing is that, like I said, at the beginning of the year we were down at around 4%, and we're right where we wanted to be, and now we're back up to hovering around 4.5. So again, hopefully things continue to get better here a little bit, and we can hopefully see these rates start to settle in and come back down, but we'll see. But all right, but let's get into residential mortgage rates here for a minute. Here are rates as of today, as per Yahoo Finance. So let's read this for a second. So according to rates from the Zillow Lender Marketplace, fixed mortgage rates are on the rise compared to yesterday. The current 30-year fixed rate rose by 5 basis points to 6.38%. The 20-year fixed rate increased 13 basis points to 6.39%. And the 15-year fixed rate inched up by 2 basis points to 5.74. So even though the mortgage rates are back up, they're, again, I've been saying this all year long. I mean, they're back up, but they're not horrific. 6.38 is not necessarily horrific. It's not fantastic. It's not where we want to be. I'd rather be right at 6%, or maybe even down, maybe 5.9, something in that neighborhood. That to me would be much more ideal. But again, it's not. The only reason I point that out is to say, with the 10-year treasury shooting up to 4.4.5, 4.6%, and with the 30-year mortgage rate still staying only around 6.38%, that's not too bad. Like, that's not too bad. It could be a little worse than that. Could be 6.5, could be 6.6. So hovering around 6.3% is not the end of the world, but it does have its effects, and we're going to see that in just 2 minutes here as I go through a couple of the real estate related articles that I want to show everyone. But just to recap here real quick. So 30-year sitting at 6.38%. The 15-year fixed is sitting at 5.74. 5/1 ARM sitting at 6.32. And the 30-year VA mortgage at 5.81. Now, as far as the refinance rates are concerned, the 30-year fixed on a refinance, 6.3%. 15-year fixed, 5.81%. The 5/1 ARM at 6.38%. And the 30-year VA at 5.78%. And that is for refinance rates, not purchase rates. So, all right, now let's take a look at a couple things here. So mortgage refinance demand drops 18% as rates hit the highest level since August. So you know what? Let me make this a little bit bigger here so that everybody can see. Let's do. There we go. How's that? I think that's a little bit better there. Okay. All right. Mortgage refinance rates drop here. So the average contract interest rate for 30-year fixed rate mortgages with conforming loan balances basically at $832,000 or less increased to 6.65% from 6.56%. Applications for a mortgage to purchase a home fell 0.4% for the week and were just 5% higher than the same week from 1 year ago. Refinance applications accounted for 38% of applications, the lowest share since June of 2025. So again, mortgage and refinance activity dropping as we've seen rates increase back up from 6% up to a high of 6.65, and then coming down and settling in at about 6.38% here by the end of the week. So mortgage applications dropping, refinances dropping, but we also have this. Sellers are pulling homes off the market at the fastest pace since 2020. So nationwide, 5.8% of all home listings were pulled off the market in April, according to Redfin. Delistings were up 3.8% compared with March. Atlanta saw the most homes taken off the market as higher mortgage rates and elevated gas prices weigh on housing. Yes. So more frustrated home sellers were giving up right in the midst of the all-important spring market, according to new data. Nationwide, 5.8% of all home listings were pulled off the market in April, according to Redfin, a real estate brokerage. I almost sounded like William Shatner there for a minute. All home listings were pulled off the market. All right, sorry guys. That's my really bad Shatner impression. This ties with December for the highest share of homes delisted since March of 2020, when the pandemic hit and the housing market froze. Delistings in April were up 3.8% compared with March. The increase comes as higher mortgage rates, elevated gas prices, and weaker consumer confidence take their toll on housing demand. Sellers are no longer in the driver's seat and aren't getting the prices they want. Atlanta saw the highest share of homes come off the market in April, with a 1 in 10 delisted. San Jose, California followed with roughly 9% polled, then Los Angeles, followed by Dallas, and then Seattle. So very interesting. We have to keep an eye on this, but not the spring selling season that we were looking for. That is for sure. Now, this is, I think, perhaps the most interesting. High prices are pushing homeowners to consider drastic steps. Now, let's go down here. So TD Bank's survey found 74% of first-time home buyers would use a 50-year mortgage. Now, we've talked about 50-year mortgages in the past. I'm not a fan of it. I don't think you should spend, if the average, I believe if again, somebody you could hit me up in the comments section here if you think I'm wrong on this one. I believe the average mortality rate for men is just under 78 years. I think it's about 77.8, something like that. For women, I believe the average mortality rate for women is like 79.7, 79.8, something like that. So do you want to spend 50 years of your life paying for a mortgage? I mean, I it's just it's ridiculous on its face. More than half. I mean, and then think about this for a second. You could do 40, right? You could do 40. We skipped 40. It went right to 50. Like, wait, what? Okay. More than half of first-time home buyers plan to spend up to 35% of their income on mortgage payments. That's high. Americans over 70 owned 26% of residential real estate wealth as of late 2025. So the high cost of home ownership is pushing first-time home buyers to consider costly steps. That's according to a new survey by TD Bank, which found that 74% of Americans planning to buy their first home would consider using a 50-year mortgage if it was available. 78% of younger millennials and 74% of Gen Zers would use their 401k plans to help purchase a home if it was allowed. And I think that should be allowed. I think that should be allowed. If you're able to save 400, or if you're able to save 400, if you have a 401k and you've been able to save money in it, I think you should be able to pull that money out tax-free if you are using it for a down payment on a house, without a doubt. I think that should absolutely be allowed. Now, I know Wall Street doesn't love that. Maybe some people in the government may not love that, but I love that. I think that is I think that's a great idea because, again, think about it. If you're 25 and you start saving money in a 401k, it is totally possible that within 10 years, by the time you're 35, you could probably have, 100, 150,000, maybe if you're a really really good saver, maybe you got 200,000 in that 401k. It also depends on how much money you make as well. I mean, that's also a factor in it as well. But let's just say your average 25-year-old gets a job, and their first job, they're making, $50,000 a year. And from the time they're 25 to the time they're 35, they go from making 50,000 to now maybe they're making 100, or maybe they're making 120 a year, something like that. So just consider something basic like that, which I think is very typical. That's not, unheard of in the marketplace. So let's say in that scenario, I think it's very plausible. You could save 100, 150, $200,000 in a 401k. And let's say you were going to buy a, $450,000 house, and you needed $80,000 to put down and then cover the closing costs. So why shouldn't you be able to take that out of your 401k? It just doesn't. Like, you should absolutely be able to do that, because think about it. At that point in your life, at about 35 years old, even though, you have to consider the time value of money and dollar cost averaging and all that stuff. But again, I think you're at an age where it's more important to buy the house, start your family, get everything rolling there. Then you still have 30 years to save up a nest egg for retirement. So again, I think this should be allowed. I think you should be allowed to use your 401k to take out money tax-free to put down on a house, to put a down payment down on a house. So first-time home buyers desire and motivation to buy remains strong, and they are approaching their budgeting and financial boundaries with flexibility, said Steve Kaminsky, head of residential lending at TD Bank US. They are open to various alternative approaches to make that first purchase possible amid elevated rates, broader economic uncertainty, and limited inventory. 31% of the prospective first-time homebuyers surveyed said they have reduced or stopped contributing to retirement accounts while saving for their home purchase. See, and that's the same kind of thing. What's the purpose of having the 401k if people are going to reduce or stop contributing because they're trying to save money for the house? Let them put the money in the 401k, let it earn interest, let it earn a return, and then let them take that money out to put the down payment on the house. I mean, it's such a simple solution. Meanwhile, 54% of the respondents said they plan to spend up to 35% of their monthly income on mortgage payments, despite guidance suggesting no more than 28%. That's 54% response rate is up from 48% in the 2025 survey. Many home buyers won't be able to make the numbers work without outside help, and 67% of first-time home buyers said they are receiving or planning to receive financial support from family. That number rises to 76% among millennials specifically, and 70% for Gen Zers. Inside the numbers on a 50-year mortgage, the idea of a 50-year mortgage was floated by President Trump late last year before it was walked back. Housing experts have noted that a 50-year mortgage would lower overall monthly payments by a small amount, but would add a large amount of interest to the overall cost of a house. Yes, yes. Here's a little exercise people can do. I want you, maybe some of you guys could do this while you're following along tonight. I want you to Google, or you can put this into AI, whatever. Say, I'm going to get a $300,000 mortgage on a house, 30-year mortgage at 6.5%. And how much interest am I going to pay over the life of the loan? Run that number, and let's put that number in the, if you want to run the number and put the number in the comments. Like I said, I think if you've never done that exercise, I think you will be shocked at how much interest that you pay over the course of a 30-year mortgage. So just, that's a little, like I said, a little fun there we could do there. So yeah, the bottom line is that 50-year mortgage is ridiculous. It's ridiculous. Like, yeah, it might make the payment a little bit lower, but the amount of interest that you're going to pay over the course of 50 years is going to be an insane amount of interest that you're going to pay. And it's 50 years. I mean, it's 50 years. Who's going to live to see the end of that mortgage? I mean, that's just, yeah. I mean, all right. And then let's see here. And I think this is my last article here on the real estate thing. So real estate agents are quitting the slow housing market. So in the fourth year of struggling market, even real estate professionals who made it this far are reaching their breaking point. So Kim Taylor bet her career on the housing market. In mid-2023, the real estate agent launched her own brokerage with her husband, Gordon Taylor. The market in Fort Worth, Texas area had cooled from its pandemic era frenzy, but business was good overall. Taylor started out with a team of 7 agents and quickly bought 6 more on board. By 2024, high mortgage rates and prices were weighing on demand, and homes sat on the market. Most of Taylor's agents had to find other part-time or full-time jobs to stay afloat. Her husband took a job last year working for a school district. We just became a bleeding artery, said Taylor, who started working in real estate in 2015. The last 11 months have been the hardest of my career. She closed the brokerage this spring and joined another firm. The slowest housing market in decades is stretching into its 4th year, and even real estate agents who made it this far are reaching a breaking point. Most of them are independent contractors and get paid when a deal closes. With fewer sales to go around and homes taking longer to sell, more agents are ditching the industry or finding second jobs. The downturn is also hitting mortgage loan officers and the many other industries reliant on home sales, from appraisers and photographers to appliance manufacturers. So again, one of the things you have to think about or have to consider when thinking about real estate, particularly residential real estate, is how, there so much of our economy is built around real estate. When you think about just a regular mortgage transaction, how many people are going to be involved in that? You got the realtor, you got the bank, you've got the appraiser, you've got the title company, you got the home inspector. That's 5 different people right there, all making money off of that one transaction. Now you multiply that by the millions of transactions that go in and on every year. You kind of get an idea, and then you look at, okay, you buy the house. Now you want to make renovations, or you want to fix it up a little bit. So now you're over, shopping at Lowe's and Home Depot, hiring some contractors, all that kind of thing. So it's just, I mean, real estate is the economic engine that drives everything in this country, and it's so important. This is why I was really hoping that those mortgage rates were going to come down to just maybe a little bit below 6%, and would have helped to really stimulate a really strong spring selling season. Unfortunately, that has not materialized, and we're in this situation now. But I will say this, though, as far as realtors go, I don't think this is all bad. I really don't. And now, why do I say that? Because I think for a long time, I think that there were too many people with a real estate license. I think the real estate industry made it perhaps in a certain respect too easy to get a real estate license and to go out and sell real estate or go to work for a brokerage and things like that. And again, it is hurt the industry. It's hurt that industry in the respect that, what do you think of realtors? What do most people think of realtors? I think most people have used car salesmen and realtors basically about at the same level. And again, there are reasons for that, because you got a lot of part-timers in there. You've got a lot of people. Like I said, it's pretty easy to get a real estate license. They get in there, and I think that having too many realtors, perhaps a little bit too easy to get in. Some realtors just maybe not really putting forth the best effort, whatever. I think that has harmed the industry. Now, when you have a couple of years like this where things are pretty lean, that's going to get a lot of those people out of the business. And I think what happens is you're left then at that point with the best of the best. Now, and I feel bad for this person here in this example, Kim Taylor and her husband, because it sounded like Kim and her husband, it sounded like they were probably 2 of the good ones. It sounded like they really probably really know what they're doing. And Kim's probably a really good realtor. But unfortunately, whatever was going on down there in this Texas market, not so hot for them, but like I said, I don't think it's going to be all bad, because I think that this might actually, I think realtors should actually take a positive in this, because I think in the long run, this is going to work out actually probably very good for the realtors and the National Association of Realtors and all that, to kind of, trim the fat, if you will, cut the dead wood, get out and basically be left with your really top performers, really help to elevate the how people feel about the industry and how things go on. So just a thought there. Okay, now let's move into some economic numbers here for a little bit, shall we? So core inflation hit an annual rate of 3.3% in April, as expected. The Fed's preferred gauge showed. So core PCE prices in April rose 0.2% for the month and 3.3% for the year, against estimates of 0.3% and 3.3%. The Commerce Department reported Thursday. Now, this was over a week ago. While the annual rates were in line with forecasts, soft monthly readings could provide some hope that the burst in prices over the previous month had begun to ease. GDP accelerated at an annualized rate of just 1.6% in the first quarter, according to a revised Commerce Department reading that was below the initial estimate of 2%. So GDP being revised down for the first quarter from 2% down to 1.6%. Core PCE prices in April coming in line, and also hoping that maybe we have kind of peaked here a little bit. Maybe we've peaked here a little bit and we'll come back down. Again, I'll say this for the 100th time. It all depends on what happens with Iran. If we get a deal with Iran and that all gets straightened out, things begin to go back to some level of normal, all of this will come back down. All of this will return to normal within the next 4 or 5, 6 months. If that does not happen, if things continue to escalate with Iran, if this drags on all throughout the summer, This unfortunately will continue to get a little bit worse. So, but we will have to see what happens. Now, what are some of the ramifications of this high inflation or higher inflation, right? Well, we see right here, Republicans stare down inflation abyss with midterms fast approaching. No bleepity bleep, you know what? Republicans have said for months that inflation is former President Joe Biden's problem. Now they're staring down the barrel of an inflation crisis of their own making, and the blame game is just getting started. Trump and congressional Republicans swept into power in 2024 by promising to defeat the inflation that dogged Biden's presidency. Members of congressional GOP are now left wondering whether their priorities are in the right place. So, yes, again, and I've said this before on previous live streams or whatever, I really do believe that President Trump, for whatever reason, thought that this whole thing was going to be real quick. He thought this was going to be like Venezuela. He thought they were going to go in there, beat up their Navy a little bit, bomb the guys, take out the head guy and maybe some of his other people in the government. And it was going to, this whole thing was going to be over real fast. That has not played out at all. So now the inflation is back up and Republicans have a problem. And like I said, but this is also why I am hopeful that a deal will be reached here and will be reached here shortly, because they all know up there on Capitol Hill that this does not play well for the midterms. I think I saw today milk just hit over $5 a gallon for a gallon of milk. That's not going to play well with people. And I've been saying this for the last month. They've got to get this thing resolved. They got to get it resolved. They got to get it taken care of, because people at the end of the day, I don't care, forget the noise, forget the politics. People vote with their wallets. That's what people vote with at the end of the day. They vote with their wallets. If mom is at the grocery store and it's $5 for a gallon of milk, if mom doesn't pay, at least in my household, mom doesn't pay attention to all of this, all the stuff that I report on. She doesn't. My wife just pays no mind to any of this, right? This is for me to decipher. What mom does pay attention to are, do you know how much it cost me to fill up my gas tank this week? Do you know how much the groceries cost? Do you know it cost me over $5 for a gallon of milk? That's what mom pays attention to. That's what gets mom fired up at the end of the day, as it does tens of millions of moms all over this great country. And so this does not play well. They could spin it whatever they want. The reality is, at the end of the day, if moms are opening up their wallets and there ain't much left over after they buy gas and groceries, not going to be very happy. Not going to be very happy at all. But like I said, this is why I'm hopeful that something will get resolved here in the next few weeks, because they know that they've got to get this taken care of. Otherwise, not going to be too good for them in November. So that's just the blunt reality of it. So, all right, now let's get into some of the job numbers, some of the problems. So job openings in April surged to 7.6 million, the highest in nearly 2 years. So the Bureau of Labor Statistics reported that available employment hit 7.6 million for April, a surge of 731,000 from the prior month and the highest level since May of 2024. While openings jumped, the hiring rate slipped. Companies hired a total of 5.12 million workers during the month, a decline of 419,000 from March. So a little bit up and down here. But still, I mean, it's good that we're seeing the number of job openings jump back up to 7.6 million. And very nice surge of 731,000. That is really, really fantastic. And then we go to private payrolls grew by 122,000 in May, stronger than expected, according to ADP reports. Now, that was on Wednesday. And then on Friday, we got the jobs report yesterday. So U.S. payrolls rose by 172,000 in May, much more than expected. Unemployment dropped down to 4.3%. So our non-farm payrolls jumped a seasonally adjusted 172,000 for the period, down slightly from the upwardly revised 179,000 in April, and far above the Dow Jones consensus estimate for just 80,000. The unemployment rate held steady at 4.3% as expected. Average hourly earnings actually rose to 0.3% for the month and were up 3.4% over the past year, both in line with Wall Street consensus. So again, this is good. I mean, this is 2 straight months now. What I like, I always use the phrase, 1 month does not a trend make. You've got to see it go for basically 3 to 6 months to see really with what you have with pretty much just about any economic indicator that you're looking at. But 2 solid months of 170,000 plus in basically seasonal, payroll, new jobs created. I mean, that's good. That's good. Let's see if we could keep that going for a few more months. But those are good numbers. So job growth unexpectedly surged in May as the U.S. labor market continued a solid year of expansion. The Bureau of Labor Statistics reported Friday. So this is a labor market that is stronger than it was last year and is looking pretty darn solid despite high energy prices and higher inflation generally, said Gus Foucher, chief economist at PNC. There's no indication that the labor market needs support. So, it's kind of funny. I literally just saw Gus last week. So I just got done teaching at the Stonier Graduate School of Banking. I'm going to this last week. I'm going to give them a shout out a little bit toward the end of the evening tonight. Quick congratulations to all the graduating students from the school there this year. Phenomenal job. Well done. But yeah, I just saw Gus. Gus is actually one of the presenters there. He obviously gives kind of his economic update at Stonier every year. And so that was that's kind of funny that he's quoted in this article here. So I was literally just talking to him on Monday. And Gus is the chief economist for PNC Bank, as I said there. But what Gus is saying there, if you read between the lines, there's no indication that the labor market needs support. In other words, we don't need to reduce interest rates to support the labor market. That's really what he's signaling there. But we could see here, though, according to the chart, I mean, we've had 3 straight months here of solid growth. We had that one bad month in February where we were down 156,000 jobs, but January had 160,000 jobs. March had 214,000. Let's see here. And then last month, 179,000 and then 172,000. So 3 straight months of really solid job gains, and 4 out of the 5 months this year have been really solid. So that is very good. I mean, that is really shaping up into a good trend. And the other thing that you have to consider is, we hear kind of Armageddon all the time, right? In the news media, you see a lot of articles. Oh, Block is cutting 5,000 employees. Microsoft is laying off this. It's all the tech companies laying off a ton of people. And what have I said about that over the last month or so? I have said, and I've pointed this out. Just all the tech companies, they went crazy. They went crazy hiring people in 2020 and 2021. They hired way too many people. And I believe that right now they are using AI as the excuse to lay a bunch of these people off because they don't want to come out. Because remember, these guys are masters of the universe. They cannot afford to ever look wrong or look foolish or come out and be like, hey, you know what? Might have just hired too many people here. Now, no, they want to put the spin on it and say, oh, it's all AI. AI is just incredible. It's glorious. And it's solving all of our problems. And so because of AI, we don't need to hire all these people. Yeah, we're gonna get into the AI conversation in just a little while. I think they're gonna be hiring a bunch of those people back real soon. Yeah, we'll see. We're gonna talk about that. And the government has massively been reducing. Let me show you guys something here real quick. If I can go to X for just a second, I'm going to come back to Jim Rickards there for just a second, but I want to show you a chart from EJ Antoni here. If I could find this. Yes. So look at this for a second here. So this is the number of federal bureaucrats declined again in May, the 17th straight month of decline. So this is our government being reduced here from this is from when President Trump took office right here, 2.4 million. And now we're all the way down here to just above maybe 2,075,000 right in there. So, we have taken off over 300,000 government employees have been laid off. So the size of government is being reduced. And it's kind of funny, because when you look at this, like, you might say, like, well, we've reduced all these government jobs. Why aren't we seeing a dent in it? But we are seeing a dent in it. If we go back to the, sorry, I skipped over. If we go back to the debt clock here for just a second, we see here the U.S. federal budget deficit is at 1.654 trillion. Where was that when Trump first took office? That was at almost $2.1 trillion. So we have seen that over the last 17, 18 months. We've seen it come down from 2.1 trillion to 1.654 trillion. So again, they have made a dent. Not anywhere. This is not good enough. I'm not saying this is not good enough, nowhere near where it needs to be. But what I'm saying is that this decline here is showing up in that number. This is a big chunk of this. Laying these government workers off, saving that money is reducing some of the spending in government without a doubt. And again, and we all know the government is way too big. It's been way too big for a long, long time. So I think that this is again, this is I think this is good. I think this is great. And I think they should keep going, baby. Keep bringing that down. But anyway, let me go back to this for just a second here. So, and again, why these numbers are good. So you've got the tech guys laying people off, you got the government laying people off, and yet we are still generating these very, very solid numbers for for 4 of the last 5 months. So that just tells you that overall the job market is really not that bad. And that's a good thing. So that's a good thing. So we're gonna keep an eye on this, though. We're going to continue to monitor this trend and see how this plays out over the next 3 months, over the next quarter. So, but let's get into some other news here for a minute before we get into a little bit of our Fed conversation. So Jamie Dimon this week, he comes out and basically says JP Morgan Chase could spend $20 billion on an acquisition. We are on the lookout. Oh boy. Wall Street loved that one. They were licking their chops, boy. Oh yeah. Oh, JP Morgan. They're going to buy somebody. Oh yeah, they got all excited. JP Morgan Chase CEO Jamie Dimon said his bank could spend up to $20 billion on an acquisition in the next couple of years. Dimon framed M&A as nearly a last resort, warning that executives who lean on deal making are often compensating for weak organic growth. Any target would need to integrate cleanly into JP Morgan's operations, fit its culture, and enhance core businesses, Dimon said. So let me just say this. Citibank has been building a lot of new branches the last couple of years. They have been completely going against the industry norm, which is the reduction of bank branches. Bank branches probably topped out going back about 15, 16 years at about 96,000 bank branches in America. We're down today to probably about 74,000, something like that. So it's come down about 22,000 bank branches, over the last 17, 18 years that banks have shed. Now, and Chase was one of those banks, obviously for a few years shedding branches, but then they basically looked around the country and said, hey, there's some big markets out there, Philadelphia, Texas, maybe Boston. There are some big markets out there that we really don't have much of a retail presence in, and we really want to focus on those, and that's what they're doing. Now they're seeing what's going on in the South. They're seeing how the South, what I've reported is now what's being called the Boom Belt, the 11 states down in the southeastern part of the United States that have a $9 trillion GDP. Amongst those 11 states, they're calling that the Boom Belt now. JP Morgan, they see that. Believe me, JP Morgan Chase, they're looking at that and they're going, yeah, if we're going to build branches, we need to go to the South. What's the number one place that Jamie Dimon is focused on right now? Alabama. Bama, as my good friend Josh would say, Bama. Alabama. Roll Tide. There you go, Josh. That's for you, Josh. Roll Tide. All right. So the See, I lost my train of thought there. I'm thinking Roll Tide. Now I just completely lost myself there. All right. So the 20 billion potential that could be spent here from JB Diamond. So where I was going with that is that look at the South. If you want to see where the potential target could come, look at the big banks in I would circle those 11 states in the boom belt in the southeastern part of the country. I'm looking at Texas, I'm looking at Florida, I'm looking at Tennessee, the Carolinas. What are the big banks down in those areas, perhaps big regional banks in those areas? If I was a betting man, which I'm not, but if I was a betting man, I would be willing to bet that that's where, if there's going to be an acquisition, that's probably where it's going to come, where they want to really fill out that southern footprint, if you will. So, all right. But let's keep moving. Let's go on to some other things here. So odds. All right, now we're going to get into a little bit of our Fed conversation here for a few minutes. So odds of a Fed hike this year jump on prediction markets. So on Kalshi and Poly markets, they think that the odds of a rate hike are much higher than they were even just a few months ago. So odds of the Federal Reserve striking interest rates hits 52% on Kalshi. Those odds came after Friday's report from the Bureau of Labor Statistics revealing non-farm payrolls hit 172,000, comfortably exceeding Dow Jones expectations of 80,000. I think there actually could be one this year, and for good reason. Inflation is pretty sticky, said former Federal Reserve Vice Chairman Roger Ferguson on CNBC's Squawk Box. So let's go down here. So chances that the Federal Reserve increases interest rates this year shot up from 25.3% to 52% in the last week on prediction markets platform Kalshi. Those odds come after Friday's report from the Bureau of Labor Statistics revealed, obviously, the good payroll report, which we've talked about. But again, very interesting here. Odds that the Fed hike will happen this year jumps in the last week. So again, very, very interesting here in the odds jumps. And remember what Gus said just a few articles back. Remember what Gus said. He basically said, yeah, this is pretty good. The labor market doesn't really need any support right now, meaning that they don't need any rate cuts to support the labor market. So, but they might need a rate hike to bring down inflation or help with bringing down inflation. Now, that may be true. That may prove to be true, but I would say what needs to happen first, again, I keep saying it, I feel like I'm beating a dead horse. Iran situation's got to get resolved first. Okay. We need that to get resolved. Strait opens back up, global markets calm down, oil production starts to increase back to normal. Then I think we would see this inflation number begin to come back down, and actually come back down somewhat quickly, at least cool off rather quickly, and probably get back down to the, probably 2.5% range that it was hovering at, 2.4, 2.5%. Then I think you can make it. Then I think if that happens and we could get back to that point, at that point, I think that you can make a real argument to say, like, okay, maybe we do need to increase it up. We need to do a 1 or 2 interest rate hikes, take it up 25, 50 basis points to try to fully beat the inflation back down to 2%. At that point, maybe you can make that case, depending on how the overall economy, the labor market, what does GDP look like, and all that. But like I said, the Iran thing has to happen first. So, okay. Now let's go into Fed Chair Warsh makes his first hires at the central bank, including Project 2025 author. So Kevin Warsh has made his first 2 hires after his swearing in as Federal Reserve Chair last month, according to a person familiar with the matter. The 2 men, Paul Winfrey and Daniel Heel, are interim advisors who will work with Warsh on policy. Winfrey's contribution to the Project 2025 policy book set out potential reforms that go beyond Warsh's calls for regime change at the Fed. Federal Reserve Chair Kevin Warsh has hired 2 conservative economic policy researchers to work with him at the central bank, according to a person familiar with the matter who asked not to be named, to discuss sensitive personal matters. It probably was Jerome Powell. I'm just kidding. I kid. The 2 researchers are Paul Winfrey, The author of the chapter on the Federal Reserve and the Conservative Policy Blueprint Project 2025, and David Heel, a fellow at Stanford's Hoover Institute think tank, where Warsh held a position before joining the Fed. The two are working as temporary contractors to support Warsh in his policy analysis and planning on special projects in the areas in which they have worked with him over time, the person said. Warsh hasn't yet made other permanent hires, this person said. Warsh's personnel decisions will be closely scrutinized by Jerome Powell. Sorry, I can't help myself. His broad network of advisors includes many prominent figures, including former Secretary of State Condoleezza Rice, investor Stanley Druckenmiller, and Chevron CEO Mike Wirth, all of whom appeared at his swearing in last month at the White House. But Warsh appears to have relatively few close advisors who have worked at the Fed or other major central banks. Warsh has positioned himself as an insider turned critic after serving at the Fed as governor during the 07-08 financial crisis under Chair Ben Bernanke. So again, how do I want to say this? I want to see Kevin Warsh shake things up at the Fed. I think the Fed needs a shakeup. I think there's way too much groupthink that goes on over there at the Fed. I think that their ideas have been either bad, have fallen flat on their face, or have been flat out wrong. That's been their track record over the last 30 years. They're always a day late and a dollar short. So I think it is well past time for some new thinking over at the Federal Reserve. I think it's well past time for somebody to come in there and shake things up a little bit. And you're not going to do that by working with people that are already sitting at the Fed. No, you need to bring in some people from outside the Fed who are going to bring some different ideas, some different thoughts to the table. And just because they're bringing different ideas or thoughts to the table does not automatically make them bad, which is the insinuation from this article. This article, if you were reading between the lines here, is basically insinuating, with the whole Project 2025 comment, is already insinuating that, oh, look at these whack jobs that Kevin Warsh is bringing into the Fed, and Lord knows what damage they're going to do. That is basically the picture that this article is trying to paint. And what I'm saying is I'm going in the other direction and saying, no. I'm going to give Kevin Warsh the benefit of the doubt here. I'm going to give him the benefit of the doubt and say, yeah, let him hire. And these guys, these aren't permanent employees. They're just coming in as consultants. They're coming in to help him on some of the projects, help him probably flesh out some of the things that he's working on, trying to figure out, how do we make the Fed work better for the American people? How do we get a lot of this stuff straight? How do we get a lot of the problems at the Fed straightened out? So again, I like it. I like it. So far, so good. Let's give him some time. Let's let him cook. Let him cook. Let him see what he comes up with. So, all right. Now, Jerome Powell, meanwhile, he was over at the John F. Kennedy Profiles and Courage Award, receiving his award for Liberal of the Year. I'm joking. Just calm down. Okay. Nobody, keep it chill in the comments there. Okay. Nobody freak out. It's a joke. Come on, it's a joke. Come on, man. The John F. Kennedy Profiles and Courage Award. Who else is going to be giving that award? Really? Okay, so but five takeaways from Jerome Powell's award speech. Okay, now we're not going to get into all this thing, but let's hit the highlights here. So number one, like many other institutions, the Fed has been undergoing a stress test. Yes, and whose fault is that? Oh, that would be Jerome Powell's. Number two. If any administration finds a way to remove Fed officials over policy indifferences, then future administrations will do so as well. So yes, I'm not a believer in the whole independence of the Fed. I've said this many, many times. If the Federal Reserve wanted to be fully independent, they shouldn't have called themselves the Federal Reserve. They could have called themselves the bank of the big bankers. Might have been a more accurate description. But again, I do not believe in this whole fallacy, if you will, of the Fed's independence. I believe that the Federal Reserve, the chairman of the Federal Reserve should serve at the pleasure of the president, just as every other employee in the United States government does. No more, no less. And that is not a Trump thing. This is not a Trump thing. That is an every president thing. Every president, and there are many presidents over the last 100+ years that have had issues with the chair at the Federal Reserve. And I would bet you $1 billion that if you were able to line up all those presidents over the last 100 years and basically say, do you think the president should have the ability to fire the head of the Federal Reserve? I guarantee you every single one of them would say yes, 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 yes. And again, and it's not to say that, somebody's going to fire somebody willy-nilly. No, no, no. But again, I mean, because I asked the question, what do you do? Like, if the head of the Federal Reserve is a buffoon and he's just wrecking the economy and he's just doing horrible things with monetary policy, we're all just supposed to just sit there, and this guy refuses to, this guy or girl refuses to leave. We're what? Like, we're just supposed to sit there and just let this person destroy the economy or continue to make one bad decision after the next? Like, I mean, come on. I mean, it's just it's ridiculous. It is ridiculous. But like I said, they're going to defend their independence, for forever. So let's see here. Number 3. Partisan political differences are normal, indeed essential in a thriving democracy, unless it's Trump saying it. Unless it's Trump saying it, okay? Any other president could have an opinion on interest rates or say what they think or whatever, except Trump. Trump's not allowed to say that. The minute that Trump says it, it's a huge problem. So just there's that. So number 4, democratic institutions take much time, effort, and patience to build, but can be torn down all too quickly. Okay, yeah, all right. Number 5, what the public has every right to expect is that we will make our decisions based only on our best economic analysis of what would most benefit the people we serve. Well, that would be interesting, Jerome, because you didn't do that for 8 years. You didn't do that. Janet Yellen didn't do that. Ben Bernanke didn't do that. Okay. Alan Greenspan didn't do that. None of you guys have done that over the last 30 years, 30 plus years. So that is pretty rich for him to make a statement like that, to basically say, oh, we only act in the best interest of, what's the benefit of the people. No, you don't. No, you don't. You have created the greatest disparity in economic wealth in the history of the world. Okay, not the history of the United States, the history of the world. Okay, the top 1% now has more accumulated wealth than the bottom 50% of the world. Okay, of the United States and the world. Okay, that is all done by you. That's all you're doing. You did that. Okay, nobody else. You. So just something to think about as we go to sleep tonight. So again, Jeremy Powell receives his Liberal of the Year award for standing up to Trump. Great job. Great job there, Jerome. And, so now Jerome is going to just be a thorn in everybody's butt, particularly Trump's. Now, before you say, oh, well, Joe, you're just some silly little podcaster on YouTube. How could you say that? Well, let's look at James Rickards here for a second. So Jerome Powell is keeping his seat on the board of the governors for the Federal Reserve, which does not expire until January of 2028. Powell is sticking around for a reason. He hates President Trump and he's trying to bring him down. So there you go. James, I feel that way. James Rickards feels that way. James Rickards, respect that guy, a brilliant dude. Written a lot of great books. If you haven't read any of his books, I highly recommend you check them out. I've covered a few of his books here on the channel, done a couple of book reports, if you will, on them. So if you want to go check those out, you can. On the channel, you can look them up on YouTube, easy to find on my channels. I have everything categorized and broken down very nicely. So, okay. Moving on now. So this is really interesting. So I want to show everybody something here in just a second on the Bloomberg terminal. So this says Kalshi is building a prediction markets Bloomberg terminal for high-end traders, source says. So Kalshi is building a new product for its highly engaged traders, according to a source familiar with the company's plans. The inference, which CNBC was shown, allows users to manage multiple positions in varying events contracts and a choice to reduce the friction to place a trade. A timeline for a launch was not disclosed. So prediction markets platform Kalshi is developing a new interface for its highly engaged traders to track the company's prediction markets, according to a source familiar with the plans. The product, which the source compared to the Bloomberg terminal for traditional equities and derivatives, is currently in alpha testing with a select group of traders on the platform and has been in development for about a month. Now, could those select group of traders be over at Susquehanna? Maybe. One wonders. One wonders. Some of the features of the interface, which were shown to CNBC, include tracking popular contracts by 24-hour volumes across various categories, the ability to see all trades as they're actively placed, and also to view individuals' contracts order books. Users can customize their interfaces to see event contracts related to their own portfolios and are able to manage multiple positions in varying markets at the same time. Traders also can enable an option to reduce the friction to place trades. Kalshi declined a request to comment. So the source said the company is creating the software to establish a singular product for its highest engaged retail traders, colloquially known as sharps, who typically use custom workflows to enhance their trades and gain an edge. The source didn't know if Kalshi plans to monetize the platform either at a potential launch or in the future. Now, for some of you out there, you might be sitting there saying to yourself, what is a Bloomberg terminal? Wonderful question. I'm glad you asked. So let's take a look at that. So here's from Investopedia. So what is a Bloomberg terminal? Features, cost, and competitors. So let's take a look here. The Bloomberg terminal is a premium financial software platform that provides professionals with real-time market data, analytical software, and trading capabilities. It is widely regarded as the best all-in-one product for global financial information. Yes, so the Bloomberg terminal is the gold standard for traders on Wall Street and has been for a very long time now. And now let's take a look at some of the things here. So a Bloomberg terminal is a comprehensive software platform for financial professionals that provides real-time market data, analytics, and trading tools. So think about it. So for realtors, like realtors have the MLS, the multiple listing service. That gives them all the goods that they basically could see, all the properties on the market, see all the backdoor information, everything like that. That's all in MLS for the realtors. So think of the Bloomberg terminal is that system for Wall Street. Okay, they get to see all the trades that are going on. They get to see what the big movers and shakers are doing. They can see all the market action, and this is why the pros will always have the massive leg up on the retail traders, because they have access to the Bloomberg terminal, which tells them everything. Well, not everything, but 90% of what's going on. Now, the Bloomberg terminal is very expensive. Costs nearly $32,000 per year. It is mainly used by large financial institutions due to its high price. The terminal strengths include a vast fixed income database, real-time data streams, and secure messaging for finance professionals. Affordable and specialized alternatives to Bloomberg terminal exist, suitable for individuals and smaller firms. So that's kind of what Kalshi's doing there, is basically trying to create an affordable and specialized alternative to the Bloomberg terminal. Now, the Bloomberg terminal launched in 1982. But let's go through, how does a Bloomberg terminal work? Well, the Bloomberg terminal is essentially a window into a financial ecosystem. It operates through subscription-based software installed on a PC or accessed through Bloomberg Anywhere. It's cloud-based service. A specialized Bloomberg keyboard improves usability, and a fingerprint scanner provides secure login access for about 350,000 subscribers worldwide. Despite its old school black screen interface, it's been the same since 1982. It remains iconic and indispensable for financial professionals. Each terminal setup consists of three basic components: the Bloomberg Professional Software Platform, a custom designed keyboard with specialized function keys for common financial operations, and a biometric scanner for secure access authentication. So now let's go here. So what are some of the core functions? You get real-time market data streaming, financial analysis and charting tools, news aggregation and distribution, trading platform integration, secure messaging system for financial professionals, and MS Excel compatibility for custom analysis. So institutional investors remain the primary users because of the substantial subscription cost, and the terminal is indispensable for various financial operations, from portfolio management to risk analysis and trading execution. The system's value lies not just in its features, but in how it seamlessly integrates these components into a unified platform that can be accessed from anywhere through Bloomberg's remote access service. So, and again, I'm not going to get into all this stuff or whatever. I just wanted to explain to everybody what the Bloomberg terminal is and why this could be a very big thing that Kalshi is doing. So again, what we talked about the Bloomberg terminal. So now Kalshi, they want to basically build the Bloomberg terminal version, if you will, for prediction markets. And again, the threat is that if they can nail this down, then they can begin to integrate other aspects of things that Bloomberg is already doing, create a better mousetrap, if you will, and then maybe someday take over that market. Maybe we'll see. Bloomberg is pretty entrenched. I mean, they have got a pretty amazing. That Bloomberg terminal is a pretty amazing system. With a lot of tech, and Bloomberg is, Michael Bloomberg's super wealthy guy. The Bloomberg terminal has made him a super wealthy guy, and I think they've got enough money to keep putting into research and development that hopefully they might stay one step ahead of the competition. But again, just a very, very interesting development there. So, all right. Let's see here. I think I got Trump accounts, and then all right, let's do Trump accounts real quick, and then I'm going to switch gears and we'll come back and we'll do the whole AI conversation. So Trump accounts, the app launches. Here's how to get started. So the Trump accounts app is now up in the App Store. You can go download that. Families can now download the Trump accounts app, which launched on Thursday. Starting in July, parents and guardians will be able to fund the new Trump accounts, also known as 530A accounts. Families must first open accounts for their kids by filling out IRS Form 4547 on trumpaccounts.gov. While all U.S. children under the age of 18 with a Social Security number can sign up, a $1,000 deposit from the Treasury is only available to children born between 2025 and 2028. So again, if you just had a kid in the last year or so, or if you're about to have a kid, or if you think you're going to have a kid next year, so you definitely want to sign up for this. You want to sign up for this. You want to get that $1,000 and definitely take advantage of this because I think this is going to be a stellar program for anybody's kids out there right now. It's in a certain respect, it's like it's free money. Why not take advantage of it? But like I said, so the Trump accounts app is out there, but before you have to go to trumpaccounts.gov and you have to fill out IRS Form 4547 for their kids. Then you can go download the app, get the kids signed up, and then, like I said, if they're born between 2025 and 2028, they can get the $1,000 here. So, like I said, just wanted to mention that. So now. All right, let's switch gears here for a minute. This is the time in the program where I like to give everybody the economic indicators for the week. I like to talk some banking news, of which I have a lot because I got two weeks worth of banking news here, so a lot to go through there. And then I also like to go over the episodes that I put out over, in this instance, the last 2 weeks. I got 11 episodes to go over, so I'm going to try to go through those very quickly and not try to take a whole lot of time there with that. But let's kick off here with economic indicators for this week. So Monday, June 8th, we get consumer inflation expectations for May. On Tuesday, June 9th, we get the ADP employment change weekly, the trade balance for April, existing home sales for May, 3-year Treasury note auction, the API weekly crude oil stock. On Wednesday, June 10th, we get core CPI for May, 10-year note auction, the federal budget balance for May. On Thursday, June 11th, we get the OPEC monthly report. We get the initial jobless claims, continuing jobless claims, core PPI, and regular PPI for May. And then finally, on Friday, June 12th, we get the Michigan consumer expectations for June, and we get the U.S. Baker Hughes total rig count. So a lot of really important Data coming out this week with the CPI coming out and the PPI coming out. And then also looking at some of these treasury note auctions. So some very big things coming out this week. And we will keep an eye on all of those to try to get some continued inkling as to what might continue to transpire with the inflation market. Okay, so all right. So now let's get to some bank news, shall we? So SBA doubles cumulative 7A and 504 loan limit. So the Small Business Administration recently announced a new rule that will allow eligible borrowers to combine their 7A and 504 loans for up to $10 million in SBA-backed financing. So that's great. So if you're looking for an SBA loan anytime soon, you can get a whole lot more. Factory orders rise in April. Services sector expands in May. Let's see here. Economic activity increases in recent weeks, according to the Fed's Beige Book. So economic activity increased at a slight to modest pace in 10 of the 12 Federal Reserve districts from mid-April through May, according to the latest Beige Book of regional economic conditions. Consumer spending remained mixed. Manufacturing activity increased at a modest to strong pace for most districts. Banking conditions were stable. Agricultural conditions were unchanged or declined, and business outlooks for the next 6 months were reported to have little change in anticipated growth. So that was the overall findings there in the Beige Book. Construction spending increased in April. Manufacturing activity expands in May. FDIC Ombudsman details activities in 2025. So the FDIC Office of the Ombudsman said it received 114 banker cases in 2025, according to their 2025 annual report. So I'll be doing an episode covering more of that. Consumer confidence decreased in May. Home price increases slowed in March. New home sales dropped in April. Consumer spending rose in April. And like I said, first quarter GDP was revised down to 1.6%. Consumer sentiment was down sharply in May. And then a couple of Fed notes here. So the Fed's Waller said the Fed should hold rates steady in the near term. So Federal Reserve Governor Christopher Waller said the Fed should hold targeted interest rates steady for the near term. Now, Fed's Cook basically said, Federal Reserve Governor Lisa Cook said monetary policy risks remain tilted toward higher inflation, and the right course of action is to hold rates steady. So there's a couple of Fed governors that are basically saying, hey, let's just hold rates steady and let's maintain the status quo for the moment. Treasury launches Trump accounts. We just talked about that a second ago. Trump issues executive order on AI. We're going to talk about that in a minute. Treasury should wait to establish stablecoin framework. So I got a couple articles here on updates to the Genius Act and the Clarity Act. So this one from the ICBA said it is concerned that the Treasury Department is proposing to establish the OCC's payment stablecoin regulatory framework as the basis for comparing state regulatory frameworks, even as the OCC's proposal is unfinalized. So again, ICBA has some concerns about that they want to continue to monitor. ICBA also urges regulators to ensure that the Genius Act report accounts for payment stablecoin risk. So ICBA and other groups issued a joint letter calling on regulators to recognize and address several key risks in their first report on payment stablecoins under the Genius Act. So some of the recommendations here, they're looking at the vulnerability of payment stablecoin issuers to runs, the contagion risk from the rapid redevelopment of payment stablecoins both within and outside the stablecoin industry, the effect of yield-like arrangements on stablecoin growth, and the reduction in the availability of credit due to such growth, the risks from stablecoin lending, and the risks from the Genius Act's multi-regulatory framework, creating opportunities for regulatory arbitrage that could concentrate risk and undermine safety and soundness. So I think there are a lot of really good things there stated by ICBA around the Genius Act and some of the things that should be being thought of right now. FDIC issues their BSA proposal for payment stablecoin issuers. So the FDIC released a proposed rule to implement Bank Secrecy Act and sanctions compliance standards applicable to FDIC supervised permitted payment stablecoin issuers, or PPSIs, under the Genius Act. The proposed rule would require FDIC supervised issuers to comply with applicable anti-money laundering, counterterrorism financing regulations, economic sanctions programs, and reporting requirements. Establish and align supervision and enforcement provisions for issuer AML CFT programs with financial crimes enforcement network requirements. So again, I mean, nothing real shocking or, about that. I think it was always going to be that either under the Genius Act or the Clarity Act, anybody who was going to deal with this, whether it would be banks, otherwise would basically have to comply with AML and BSA and all that. So just pointing that out. Fed report, banking system remains strong. So the Federal Reserve released its latest supervision and regulatory report, which summarizes banking conditions and the Fed's supervisory and regulatory activities. So more to follow on that. The Fed's Michelle Bowman, community bank regulatory relief remains a priority. So Federal Reserve Vice Chairman for Supervision, Mickey Bowman, is set to tell Congress today that community banks serve as critical sources of credit in their communities, and an appropriately calibrated regulatory framework remains a priority for the Fed. So that's good. Regulators report to Congress on community bank relief efforts. So we will keep an eye on that. ICBA and other groups urge the FHFA to tackle the administration's housing priorities. So ICBA and other groups sent a letter to the Federal Housing Finance Agency regarding President Donald Trump's Promoting Access to Mortgage Credit executive order, and recommended ways the agency could improve the availability and affordability of mortgage credit. ICBA backs the CFPB's housing affordability efforts. So the ICBA said it supports the Consumer Financial Protection Bureau's efforts to implement regulatory changes outlined in the recent executive order addressing housing affordability and access to mortgage credit. Agencies remove more references to reputation risks. So the federal banking regulators updated 15 interagency documents to remove references to reputation risk. In addition, the SEC proposes rescission of climate rules. The Securities and Exchange Commission proposed repealing rules that require public companies to provide certain climate-related information in their registration statements and annual reports. Thank goodness. I very, very happy that that is going by the wayside. Group challenges CFPB on ECOA rule. So several organizations filed a lawsuit challenging the Consumer Financial Protection Bureau's final rule, revising Reg B, which implements the Equal Credit Opportunity Act. Okay, we'll have to keep an eye on that one. ICBA to OCC rescind Coinbase Trust Charter. And then also OCC approves the trust bank charter for Laser Digital. So I don't think that there's much hope that the OCC is going to rescind Coinbase's charter. I just don't. I mean, ICBA has been on a tear opposing all these companies that have gotten bank charters. Again, I don't think that's going to change. I don't think that's going to go anywhere. They're basically getting their charters, and you're going to have to deal with it. ICBA urges OCC to protect minority banks. So ICBA urged the OCC to retain minority depository institutions on the list of examples of permissible public welfare investments, so MDIs can continue to advance public welfare by serving low and moderate income communities. Yes, good thing there. ICBA. Groups issue report proposing third-party risk management reforms. So ICBA and other groups released a report outlining principles and proposed areas for reform to third-party risk management. So with banks operating in a fundamentally different vendor ecosystem than that which shaped existing TPRM expectations, the report said there is a widening gap between what current guidance envisions and what is operationally achievable. The report says the solution is reorienting supervisory expectations. And then finally, ICBA supports revising the Farmer Mac charter via the Farm Bill. ICBA encouraged the Senate Agricultural Committee to update the Farm Bill, the Farm Food and National Security Act, with targeted provisions to address outdated restrictions within Farmer Mac's charter. So, okay, I think sounds like that would be pretty good. But there is our banking news for the last couple of weeks. Now I want to switch gears and I want to get into the episodes that I've put out over the last 2 weeks here. So I had 5 this last week, and then I had 6 the week before. All right, so let's go into this for a second here. So, and again, I'm going to run through these rather quickly because I really want to get back to the articles because I have a lot to talk about with AI and private credit updates, and then a little bit of update on the auto industry at the end. So I did 2 weeks ago, I did a BND bonus strategy room bonus episode called The American Citizen AI Revolt Has Begun. So very interesting if you have not checked that out. Then I did CEO used an AI clone of himself. So yes, so Customers Bank CEO Sam Sidhu caused quite a stir when he used an AI clone of himself for the first 25 minutes of the bank's most recent earnings call to provide prepared remarks. So yes, a very interesting episode there. Then I did is Mythos, the beginning of endless cyber attacks. So what has AI unleashed on the banking industry? Anthropic's development of Mythos has sent shockwaves through banking executives. And then Palo Alto Networks chief, tech chief, Lee Cleric sees a small window before hackers begin to use programs like Mythos to launch attacks against software vulnerabilities. Then right after that, I did regulators are looking to overhaul the CAMELS rating for banks. So the CAMELS rating system is used by bank regulators to assess a financial institution. The rating system evaluates 6 key factors: capital adequacy, asset quality, management, earnings, liquidity, and sensitivity. Banks are then rated on a scale of 1 being the best to 5 being the worst. The scale helps examiners to determine which banks require closer supervision because of poor performance. So yes, and now very, very interesting very interesting episode that I did there on CAMELS. I think there's a lot more conversation to come around that as these potential changes either get made or implemented or adjusted. And so I will definitely have more on that. I'm sure that I will be doing additional CAMELS related episodes as we move forward here. And then I did a bank news episode, CEO apologies, executive orders, living wills, charters, exemptions, and fines. So basically the format of those episodes when I do those banking news episodes is I basically get 10 or 12 articles and I just run through them just to give everybody basically like the week's rundown of a whole bunch of banking news, things that were going on. Basically a lot of stuff that I don't have the time to cover here in the live stream. I'm starting to, like I said, put those into those bank news episodes. And I think it's a great way. You get about 10 to 15 minutes. I give you kind of a rundown on a lot of the bank news for the week, and usually some pretty good gems in there. So okay. Then last Saturday, I did an episode which I thought was really important, really, really important. It's called How Can Banks Better Engage with Customers in the FinTech Era? So banks are constantly challenged in the FinTech era, not with losing accounts, but with maintaining day-to-day financial engagement. Consumers continue to diversify away from bank offerings to multiple FinTech platforms, mainly for P2P payments and digital wallets. Banks' share of the financial relationship with fintechs is shrinking. Speed, flexibility, and control are the main items that customers are looking for. Payments are the front door for customer engagement. Right now, Venmo and Cash App are winning the race, but banks have options such as Zelle. Banks can retain financial engagement with their customers, but it will require them to make changes and adapt current offerings. So yes, this episode is just it is extremely critical to understand the realities of what banks are competing on today, and understanding that it's not so much that they're not losing accounts, they're not losing deposits per se. What they're losing face time, they're losing engagement with the customers. Like in other words, say somebody has a couple of financial apps on their phone, right? Say they've got PayPal, they got Venmo, they got Cash App, maybe they got Coinbase or something, and they've got their mobile banking app, right? So they got all these apps on there. the point being is this: they're going to be on PayPal, they're going to be on Coinbase, probably on average multiple times a week, maybe even multiple times a day. Their bank app, they might be on that once a month or maybe a couple of times a month, the 3-4 times a month they might log into that. So the point being there is that is not it's still obviously critically important to their financial life. They need it, they do use it, but it's not necessarily top of mind, right? Like they're using these other financial apps far more frequently and far more often. And so that is the wallet share, if you will, of, or the wallet space, and it's the engagement, right? It's the engagement that is what is, I think, in very much in jeopardy for banks. Like, in other words, as the younger generations continue to have more and more increased engagement, particularly around the payment space, to these other fintechs, these other providers, where does that ultimately lead for banks, 10, 20, 30 years down the road? That is the big question. So, all right. And again, I think that episode really gives it should be keeping every banker up at night. It should be keeping every one of them up at night, because that's what you should be thinking about. How am I engaging with my customer every single day? Every single day. How am I engaging with my customer? What am I doing to stay front of mind with that customer? What am I doing to continue to expand that relationship with that customer? Again, that should be on every banker's mind out there. That should be probably the number one thing, because these fintechs are coming to eat our lunch, no doubt. So anyway, all right. So then that was for 2 weeks ago. This week, I put out 5 episodes. Starting on Monday, I did FDIC reviews deposit runs on 3 large regional bank failures in the spring of 2023. Now, this report from the FDIC, it looked at the bank runs, particularly the deposit flows, and the report was called Dissecting Deposit Flight, from the 3 large regional banks that failed in the spring of 2023: Silicon Valley Bank, Signature Bank, and First Republic Bank. And this report was, in a certain respect, not too shocking. Nothing there that perhaps we didn't already know, but some really good information in this report, and some really shocking things that came out. Like Silicon Valley Bank lost 50% of their deposits in one day. One day. They lost 50% of their deposits. I mean, that is just beyond shocking, So again, and so I think, and there are a lot of takeaways for bankers there in terms of thinking about your liquidity, and thinking about liquidity risk, and thinking about, again, one of the biggest thing that bankers do is they think that when a deposit comes in the door, that deposit is just going to stay there. I think all bankers are guilty of this. They get this. I think they get way overconfident in their deposit base, thinking that, like, oh, well, the deposit base is there. There's nothing. They're not leaving. They're not going anywhere. They're not. All those deposits aren't going out the door tomorrow. True. And maybe not true. It depends. Like I said, if something like this happens again, if you have a shock of some kind, is this going to repeat itself again? And if it does, is your bank in serious trouble? So again, so I think there's a lot of really interesting thoughts, really interesting takeaways from this episode. And then I followed that episode up on Tuesday with, what would the experience of a bank run be like today? So, we've all seen the movie It's a Wonderful Life with Jimmy Stewart. Jimmy plays the president of a small savings and loan bank, and in one of the pivotal scenes of the movie, he prevents a bank run by talking to the customers and explaining how the bank works. Bank runs have been prevalent in the U.S. since the founding of the country, as noted in various panics throughout the 19th and 20th centuries. But will a bank run today be like the bank runs we have experienced in the past? And the answer is probably not. So again, I kind of get into that whole topic there in that episode, talking about what could a bank run possibly look like today. So again, both those episodes are very much interlinked, intertwined, and so you go check those out. Then on Wednesday, I had another basically private credit update. I did private credit lending to NDFI slows, BDC, Business Development Corporation valuations, and MFS losses. So you can check that out if you want the private credit update. And then on Thursday, I did should banks adopt buy now, pay later? Interesting thought here. As consumer usage of buy now, pay later continues to increase, banks should consider offering this product for their customers. Should banks? It's a question. Should banks consider offer this product to their customers? 50 million consumers have used buy now, pay later over the last 12 months. Total transaction value increased to 70 billion in 2025. However, there are problems with buy now, pay later that persist. There are concerns with consumers around delinquency and behavioral finance issues. There are considerations internally regarding offering a product like that, such as compliance, credit risk, and consumer protection. But despite these challenges, should a bank decide to offer buy now, pay later to their customers, there are several options available to do so. You could do embedded partnerships, debit-based buy now, pay later, and buy now, pay later checking accounts are three options to consider. So again, we will definitely be talking more about buy now, pay later into the future. I do think that that is something that banks may want to consider. If we see the growth trends, if we see this continue into the future, yes, I think that that is something that might need to be considered. And then finally, yesterday on Friday, I did what I thought was a very, very important episode, and that is why have 7 million men dropped out of the labor force? The Department of Labor recently reported that the labor force participation rate for prime age men, that's ages 25 to 54, dropped to 66%. So about 1/3 of men, or approximately 7 million, have dropped out of the labor force altogether. This is a shocking statistic, to say the least. There is no doubt that the country over time will feel the absence of these men in a very profound way. The big question right now is, how did this happen? There is not one single issue or event, but a compounding of changes over many decades that led to this point. The loss of Americans' manufacturing base in the 60s, 70s, and 80s, the belief that college was going to be the magic job elixir for everyone, the dot-com bubble, the Great Recession, the rise of wokeness and DEI, COVID, and H-1B visas have all conspired to play a part in making this happen. How can we fix this? How do we turn this around? Great questions. Maybe not so many great answers in the short run, but I think that this is a topic that is a major, major topic that many people are not discussing. They're not talking about. And this is something that we do need to start talking about. We do need to start talking about the 7 million men that are sitting at home, not doing anything. That's a problem. That is a big time problem. So again, I hope that I can just help in some small way to begin to spark a conversation around this. And hopefully people will share that episode, and it will spark some conversation. It will spark some people putting some thoughts into that, because I do think that that is a profound issue for this country, and it is imperative that we get those men back to work and get those men back in the workforce. It is imperative. The issues for this country could be immense over the next 30 years if we let those 7 million men just languish, because it won't be just 7 million men. It'll be more than that. It'll be 7 million, and then 10 million, and then 15 million. This is a problem that has to be addressed. So, all right. That's what I got. Wow, man, a lot of episodes. I think a lot of really good episodes over the last 2 weeks. So a lot of good stuff rolling through there. But now let's get back to some articles here. If I can get back over here. All right, let's pick up. Let's get into our AI conversation here. So Trump signs an AI executive order asking companies to give government early access to models. So yes, so remember, I had reported on 2 weeks ago that they basically had this executive order ready to go, and then Trump pulled it back. And now they have officially rolled it out after, I guess, making some changes here. So So President Trump signed an executive order on Tuesday on AI and national security. The order calls for the government to develop a benchmarking process to determine the advanced cyber capabilities of AI models. AI developers on a voluntary basis are asked to collaborate with the government, providing early access to what are determined to be frontier models. So President Donald Trump on Tuesday signed an executive order asking artificial intelligence companies to provide models to the federal government to assess their capabilities ahead of a full release. The order asks companies on a voluntary basis to participate in a benchmarking process to assess a model's advanced cyber capabilities and determine whether it should be considered a covered frontier model. It then asks for access to these models up to 30 days before the companies plan to release them more broadly, and enables the government to help select the trusted partners that will receive early access. Nothing in this section shall be construed to authorize the creation of a mandatory government licensing, pre-clearance, or permitting requirement for the development, publication, release, or distribution of new AI models, including frontier models, the order said. Trump signed the order in a private just weeks after he postponed a signing ceremony with prominent tech CEOs because he didn't like certain aspects of it, he told reporters at the time. Tuesday's order, which is thin on specific details, lands at a pivotal moment for AI development in the United States. On Monday, Claude developer Anthropic said it confidentially filed with the Securities and Exchange Commission for an IPO. We're going to get into that in just a second. And rival OpenAI is also gearing up for a potential offering this year. Maybe we'll get into that in a second. And then Elon Musk's SpaceX, which owns his AI lab, SpaceX AI, is poised to beat both of them to the public market with a debut set to take place as soon as next week that could value the company at well over $1 trillion. Yes, we'll cover that in just a second. The tech industry, which has seen fortunes soar during the AI boom, has played a central role in the White House's position on AI. So I will just say this. I think that this is a good start. Is this the end all be all of everything? Is this perfect? No, absolutely not. It's not perfect. It does not get anywhere near where I think it should have been 100 times stronger than what this is. This is more of like a, hey guys, listen, if you wouldn't mind, if you're going to put something out that's going to wreck the economy, could you maybe just give us a heads up, 30 days before you put it out there, and just give us a little, let us kind of see how bad this is going to be before you release it out there. This is really all kind of a handshake. It's kind of like you're dependent on the tech bros here to basically play nice in the sandbox and basically come in and show you what it is they're working on. They don't have to. This is voluntary. So if they decide that it's not necessary, they just basically just go and put it out. So like I said, I think this is a start, nowhere near as far as I think they should have gone with it. Now, as we continue on here, what's the next thing? OpenAI says it will comply with Trump's order requiring AI models reviews before release. So OpenAI has told CNBC it will comply with President Trump's AI executive order. George Osborne, head of OpenAI for countries, said that the startup would sign up to the voluntary order. Okay. Now you might be asking yourself, well, why? Why would they sign this? Why would they do this? Oh, maybe because of this. Trump administration and OpenAI discussed possible government stake in the AI startup. What could be another word for government stake? Let me think. What could be another word for that? Could it be bailout? Could bailout be another word for that? Maybe, just maybe. I think things are getting a little dicey in AI land right now, and I think the realization that OpenAI is not profitable and is never going to be profitable has hit them like a ton of bricks. And I think that I think that basically all this is like, hey, let's keep it going. I think the sales pitch here is let's keep it going until we can get our IPO. Sam is holding his breath right now going, I need to get this thing across the finish line because I need to become an Uber billionaire and I need to be able to cash my money out before this thing blows up in my face. Okay, that's where Sam is at this point right now. Um, so OpenAI CEO Sam Altman and the White House are in ongoing talks about a possible government bailout, stake in the company. CNBC confirmed. The AI startup could donate equity to the U.S. government to seed something like the Public Wealth Fund that the company outlined in its April policy proposal, according to a source familiar with the discussions. The talks have been in progress for more than a year, as Altman first shared the idea with the Trump administration in 2025, the person said. So again, I just don't like this, man. This is just bad. This is basically what Sam Altman is telling you right now is that he knows that there are major problems on the horizon, and he is trying to put the taxpayer on the hook. He wants to put the taxpayer on the hook. What do you think is going to happen when everybody realizes that that this AI bubble bursts and that OpenAI doesn't make any money, is never going to make any money? What do you think is going to happen when that happens? Its tank is good. The stock will go into the floor. It'll probably get delisted, and then John Q. taxpayer is going to get put on the hook if they do this. Okay, this is no. I would no. Sam Altman has made his bed. Okay, he stole that company. He made his bed, and now let him sleep in it. Okay, like this is ridiculous, ridiculous. All right, now let's keep going here, because this just gets better. It just gets better and better. So Amazon engineers in Seattle slam employer for building AI data centers while laying off 30,000 staffers. So let's see here. So Amazon engineers railed at their employer for conducting mass layoffs while committing to spend $200 billion this year on AI infrastructure, including data centers. The engineers spoke at a Seattle City Council meeting where officials unanimously passed a proposal to limit new mega data center developments for 1 year. Amazon has laid off more than 30,000 corporate employees since October. So again, it gets back to this whole conversation. They didn't lay those people off. They're telling you, oh, well, we laid all those people off because of AI. We laid them all off because of AI. No. You laid them off because you needed to put more money into building data centers. That was why you laid them off, not because AI was replacing them. But so again, this is just one article, and this is why I did the whole segment 2 weeks ago on the American citizen and revolt against AI. That's why I did this whole segment, because I had 20 articles all just like this on data centers, companies getting companies replacing their staff, all this kind of stuff. I go back and check out that episode. It was definitely worth it. So there we go. Corporate America is starting to ration AI as costs skyrocket. Executives are scrambling to track returns on AI investments as the bill for massive computing needs comes due. So let me make this a little bit bigger here. So, okay, so I did last year, I did a 4-part series on AI. And the reason why I did that series was because a couple of reports came out from MIT. I'm trying to remember the other one. One was for MIT. Oh, a couple were from McKinsey. And I thought there might have been one more in there. But the reason why I wanted to point that out is because all those reports basically said that all these companies had spent tens of billions of dollars on AI, and it had not generated them $1. Had not generated $1 of profit. They spent 50, 60, 80 billion dollars had been spent up to that point on AI and had not generated $1. And we're spending ridiculous amounts of money. And remember something, AI was put out there for free. It was put out for free. Now they're starting to charge for it. Now it's Anthropic and everybody. Now they want to turn the meter on. Now they want to basically say, oh yeah, okay, now if you want to use the AI, it's going to cost you big bucks. So they wanted to get everybody addicted to it first, and then basically, like any good drug dealer, we're going to give you a few samples, get you addicted, but now it's time. Now you want it, you got to pay for it. So let's go down here for a second here. So use of artificial intelligence by big companies is exploding, and the soaring cost has some of them pumping the brakes in a way that could complicate AI's triumphal march across the economy. Executives across industries this week have urged employees to integrate AI tools into their work, spending freely to encourage experimentation and seeking to send a message to Wall Street that their companies won't be left behind in a coming wave of disruption. All that enthusiasm has resulted in skyrocketing costs for so-called tokens, the basic unit of measure for AI computing, as AI model providers seek to balance supply and demand and manage their own costs. Some enterprises have hit their annual budget in just 3 months or reported seeing their AI spending bills double or triple. Now, corporate leaders are scrambling to bring down expenses by finding ways to ration AI use in their organizations, steer workers toward cheaper homegrown tools, and help them hone their skills to improve returns. Top technical executives at Uber Technologies, Meta Platforms, Microsoft, Salesforce, DoorDash, and other companies have all talked about new efforts to ensure AI use contributes to productivity or have taken steps to reduce the availability of some tools for certain employees. AI critics have pointed to efforts to direct AI spending more carefully as evidence of a warning sign that the ultra fast pace of AI growth could slow. That would potentially hurt Anthropic or ChatGPT maker OpenAI as they take steps toward public listings this year. Anthropic on Thursday closed a $65 billion fundraising round that values the startup at $965 billion. But a number of investors and tech executives cautioned against betting on a pullback, noting that sales and usage of corporate AI customers have climbed far faster than forecasts for the moment. For the moment. We're still in the pretty early innings. Yes, for AI adoption, said Will McGough, Chief Investment Officer at wealth manager Prime Capital Financial, which is invested in a number of tech companies and is closely evaluating the coming IPOs of giant AI startups. Even massive companies are still figuring things out. Just a few months ago, the prevailing sentiment around AI use at many big companies was the more the better. All you can eat subscriptions amounted to a subsidy of the model makers, which often lost money on the intensive activity of power users. Lost money, keywords there, lost money. Exhorted to embrace the wave of change, employees at some companies engaged in token maxing or using as much computing as possible in order to be seen as AI forward, a practice that continued even as the model companies shifted to usage-based pricing. So then we had the insane story over this last week of the company, and we don't know the name of the company. And I think it was McKinsey that put this out, but one of the big consulting firms, they basically said that a company had spent $500 billion in 1 month. $500 billion bill that they had racked up on AI in 1 month because they didn't put any, they didn't cap the AI usage. They just had everybody in there running wild. Now, obviously, if you run up an insane, and I don't know how they're going to pay that bill. I don't know how you pay a $500 billion bill. That's just insane. But obviously they're going to go back and basically start to cap this. But what you are starting to see is that a lot of these companies here are really going to have to start capping their AI usage because they're not going to be able to afford this. Like these AI companies are going to keep ratcheting up the subscription cost, if you will, of using a lot of this AI, and they're going to continue to do this, and it's going to slow the adoption of AI and what they're not getting. So think about that from a consumer perspective, right? So say I've got a bunch of apps on my phone. I've got OpenAI, I've got Grok, I got Claude. So you got a bunch of these AIs on your phone, right? And now you start to use it. Now I've been able to use this stuff freely. I just go in, type some things in. Hey, look at this, look at that. I want to check this out. What's this? How does this work? Explain this to me. All these kind of prompts and things like that, right? Well, imagine now, you're using that, you're going in there, and all of a sudden now, you get a bill for, $1,000 or something like that, or all of a sudden it's like, oh, you've hit your limit, and now if you want to continue using this, you're going to have to sign up to start paying us, monthly, say, I don't know, $100, $100 a month, so $1,200 a year for that AI. Now, some people will happily pay it, and they'll happily, go through it. Some people have been paying that kind of money now anyway to get some of the more advanced AIs, particularly some of the agentic bots, or maybe even some of the generative features, like for people who maybe work on videos or movies, things like that. They might have already been paying for some of these like that, but I'm just talking about the regular stuff that's out there is going to start costing money, and that there is going to be a big time crimp on that. And the big question is, will consumers, when those bills start coming due, and now it becomes more of just paying for a regular subscription service like anything else, with the fact that people are already paying money for their cell phones and their cable bills and all this, and all the streaming services and all this other stuff, will they be willing to start forking over hundreds of dollars extra every month for just the ability to use a certain AI? Interesting question. I think a lot of people probably would say no, but I think a lot of people would say yes. So it's like I said, it's very interesting to see what will happen with that. But continuing on here, let's go on to some other. All right, what's going on here? Okay. Anthropic urges global pause in AI development, flags self-improvement risk. So the 1 trillion startup warns artificial intelligence models are nearing the capability to improve without human intervention. So Anthropic is calling for top artificial intelligence labs to weigh slowing the pace of development, suggesting that AI systems are advancing so rapidly that they may soon be able to improve themselves without human intervention in ways that could pose significant societal risks. The ability to slow global AI development would likely be a good thing, the company said Thursday in a blog post that disclosed internal data documenting how quickly its most advanced models are improving. The post, written by the head of its internal research institute and a company co-founder, noted that the model advances appear to be on path toward recursive self-improvement, when AI systems can improve on their own without human intervention. Some AI insiders have seen that threshold as a potential marker of danger and enormous social upheaval. Yes, I mean, this is exactly what I'm talking about with the with the Trump executive order. This did not go far enough, and that is exactly. I mean, again, this article here from Anthropic, this just came out yesterday. This was in the Wall Street Journal yesterday. I'm sorry, June 4th, the Thursday. On Thursday, this article comes out with Anthropic is talking about this, and you have this so on the one hand, you have Anthropic dropping Mythos, which potentially has the ability, could wreck a big bank in a day. That is what you're staring at. You're staring at a system that could wreck a big bank in a day, potentially. And now you've got them coming out saying, oh, yeah, well, hey, the development's coming so close. They're going to be, AI is going to be self-improving itself pretty soon. And yet the White House is like, well, we're going to put out this executive order that just asks them to say, hey, guys, if you come across something like this, maybe kind of, could you maybe come over and give us a little bit of a heads up? Like, I mean, come on. I mean, like I said, this is ridiculous. We've gotten beyond the point of ridiculous. And it's nice that Anthropic is putting this out. It's nice that Anthropic is keeping us up to date here with this, but they're not going to play. You think Sam Altman, do you think for 1 second that he's going to stop developing anything? Like, no, he's going to hit that dude is going for broke. He doesn't care if he wrecks half the world. He is going to go for broke. If he thinks it'll make him, 50 billion, $100 billion, he is all in, baby. He is all in on it. So, all right. And then we go on to now a couple other things here. So JP Morgan CEO, AI may create things we're going to lose at. Okay. Jamie Dimon also indicated, okay, I talked about that earlier tonight. He might be on the move for an acquisition. let's see here. So the AI, it'll create things that we are better at and we can win at. It will also probably create things that we're going to lose at because competitors will find ways to bite off something. Diamond said Wednesday without elaborating. So we just have to be really, really good at it. Okay. Deep thoughts with Jamie Dimon. All right, I thought I had another article there from hang on. All right. Well, all right. We'll come back to that in just a second here. So, moving on here, we've got Anthropic files to go public in blockbuster year for IPOs. The filing could put the company behind Claude on a path to go public this fall. So, yeah. So basically, we are expecting 3 massive IPOs here coming very shortly. Anthropic is looking at the fall. OpenAI is looking at the fall. And then we've got SpaceX, which is basically coming next week. So Anthropic, basically they put their paperwork in. Their IPO is going to be coming. Then here we've got SpaceX targets. Hang on, there we go. SpaceX targets $177 trillion valuation. Let me make this a little bit bigger here. So, okay. One justification for the $1 trillion valuation is the new industries that will merge, the company said in its SEC filing. Now, what is a little unnerving about this is basically Wall Street, when I say they, I mean Wall Street. I mean, Goldman Sachs I think has taken the lead on this. They are bending every IPO rule imaginable. I mean, and bending them to the point of breaking points to try to make this thing happen. And that does not give me good vibes. That does I sit there and I'm like, man, they want at all costs. They want to make this thing the biggest IPO of all time. And okay, but it just seems to me like that maybe this some of this might backfire and this might become a big problem. But anyway, so Elon Musk's firm could become the 7th largest company in the United States by market cap, bigger than Tesla Motors on June 12th, as it plans to market its initial public offering at a fixed price of $135 per share, according to a June 3rd filing with the Securities and Exchange Commission. The filing indicates SpaceX aims to sell 555 million shares, equaling about 75 billion. The banks underwriting the deal can purchase an additional 83.33 million shares at the IPO price, bringing the total from fundraising to almost $86 billion. Musk will still control more than 82% of the voting power following the sale, though he must hold on to all his shares for 1 year. The filing noted that SpaceX will use the net proceeds to fund our growth strategy, including the expansion of our AI compute infrastructure, enhancements to our launch infrastructure and launch vehicles, increases in the scale and capacity of our satellite constellations. It will also use some of the cash to repay debt on a $20 billion bridge loan. It does not intend to declare any cash dividends for shareholders for the foreseeable future. Okay. And then going in here, investors can buy SpaceX early with Coinbase perpetual features on pre-IPOs. So pre-IPO perpetual features, contracts give traders the ability to speculate on the value of a private company without owning shares. SpaceX said, not SpaceX, Coinbase said SpaceX is the first in a planned pipeline of pre-IPO contracts offering hot sectors like AI, energy, and space. The product is available only to traders outside of the United States. Now, these are what are known as synthetic contracts. Now, if you want to know what synthetic contracts are, I did a whole episode talking about this. You can go back and look that up. I think you will find it very interesting. I think you will also find it very risky. I would not be recommending anybody to do this. If you can't get in on the IPO, just sit back and wait. You'll be able to buy plenty of shares into the future. That is for sure. Okay, Elon Musk, his net worth is poised to sail past $1 trillion. I mean, that's $1 trillion. Based on SpaceX's updated IPO prospectus, Elon Musk owns shares in the company worth more than $866 billion. That's on top of Musk's $350 billion plus stake in Tesla. Already the world's richest person, Musk is poised to become the first trillionaire. I mean, that is just insane. That's just insane. Oh my goodness. SpaceX merger chatter reignites as Musk pushes rocket company toward the NASDAQ. So, as Elon Musk prepares to lead SpaceX into the public markets, there's growing chatter that his ultimate goal is to combine the company with Tesla. Musk has discussed with colleagues the possibility of folding the companies together. People familiar with the talks told CNBC. Tesla and SpaceX already share engineers and collaborate on solving issues tied to power and compute constraints. So very interesting there. We'll keep an eye on that one. JP Morgan Chase, some other AI related articles here. JP Morgan Chase taps AI to process checks. The bank is automating the most labor intensive tasks of the process, freeing our team to focus on more complex, higher value decision making, an executive said. So very interesting. So after JP Morgan Chase's payment division introduced a mail automation robot, mail as in MAIL, not mail as in MALE. Mail automation robot at one of its lockbox sites for processing paper checks last year. The bank found that the robot can manage some 4,000 different types of envelopes and documents, the bank said last week in a press release. Created in collaboration with the Hayward, California-based AI robotics firm Ripcord. The robots open envelopes, remove and unfold documents, remove staples, and scan the correspondence, the bank said in the release. JP Morgan, the largest U.S. bank, is also using large language models to automate lockbox processing. Staffers can now access an AI assistant to view real-time processing information and focus instead on the tasks and require human input, the bank added. Now, of course, JP Morgan can afford to do that because they have like a $15 billion tech budget. So they can afford to do things like that, whereas, most banks cannot. Wells Fargo CEO, AI's effect on employment is complicated. The bank's biggest AI-related challenge is determining how the technology could transform its business model and how the lender should respond, Charlie Scharf said Wednesday. Wells Fargo CEO Charlie Scharf said Wednesday, the impact artificial intelligence will have on employment is more nuanced than current debate suggests. I find it very surprising when really smart people take one side or the other, Scharf said during an appearance at a Bernstein investor conference. They sit there and they say it's not a threat to employment, or they sit there and say it's a huge threat to employment. It's so obvious to me looking at the way we're using AI inside the company. It is both of those things. Yes, I would agree with that. The CEO said the risk is that they're not totally aligned in terms of the same people and the timing of it. So yeah, no, I really agree with that assessment. I think that there are some areas where the AI will really work to make things hopefully much more efficient, much more productive, and it will add new employees in certain areas, but it will also take away employees in other areas. And I think to what his point of what he was trying to get at there was that in the short run, you're going to see this misalignment because it'll create more efficiency. It'll eliminate more jobs that it creates at the beginning, but then that will probably shift over time. So there is that. Now, Amazon is starting to sell its AI shopping technology to other retailers. So Amazon Web Services is offering a product to help retailers launch their own AI shopping features. The tool is built on Alexa for shopping, Amazon's recently rebranded e-commerce agent. Amazon continues to turn homegrown technology built to solve internal problems into commercial services. So very interesting. Then we come down here. Your AI agent can now trade for you on Robinhood and buy stuff with your credit card too. Robinhood unveils tools that let AI agents trade stocks and make purchases on users' behalf. Our mission has always been to democratize finance for all, and now that mission extends to AI agents, said the CEO Vlad Tenev. Retail investors may soon be able to hand their keys to their portfolios and even their wallet to artificial intelligence. Yay, I can't wait. I can't wait. Just, oh, what are we doing? What are we doing? Robinhood unveiled tools on Wednesday that let AI agents trade stocks and make purchases on users' behalf, marking one of the first attempts to bring autonomous finance technology to ordinary investors rather than institutions. The new products, agentic trading and an agentic credit card, allow customers to connect third party AI assistants to carry out investing strategies or spending instructions with minimal human involvement. Users can instruct agents to rebalance portfolios, monitor themes such as AI stocks, or execute trade strategies automatically. Separate AI agents can also search for deals and complete purchases using designated virtual credit cards. So, um, Robinhood, just a few weeks back, they basically made an announcement that they were putting out they were launching a rewards credit card. Now, why are they doing that? Why do you think, credit cards would be a big thing on their radar? Payment channels. It's payment channels. Like, they don't have a P2P platform, but they could launch a credit card. And now what are they telling you here? Oh, we're going to give you these AI tools. They're going to allow you to buy things through what? The credit card that they are going to supply. And it gets all back to that episode that I did last weekend on, how do banks compete in the fintech era, and all about engagement, and how the engagement, it's that those P2P channels, it's the payment channels, that is the front door to the engagement. And that's what Robinhood is looking at, and that's what they're focusing on. Remember, Coinbase and Robinhood are locked in this major battle. They want to create the kind of all everything app, right? That's what they're focusing on right now. See all this stuff. I don't do all this stuff for no reason. All these episodes and everything I put out, this stuff all comes together. It all comes together at a certain point. So let's see. The more you watch, the more you know. There you go. All right. Morgan Stanley will soon open its trillion-dollar wealth management funnel to AI agents. So Morgan Stanley will soon allow external artificial intelligence agents to connect directly with its stock administration platform, CNBC has learned exclusively. Mark Mitchell, Chief Product Officer of Morgan Stanley at Work, told CNBC that AI agents can help corporate clients administer increasingly complex stock plans without adding human employees. JP Morgan Chase and Goldman Sachs are using AI agents internally for things like writing code, but have yet to publicly announce steps to allow external agents to connect directly to the firm's systems. I can't wait to see that. That is going to be some fun days, baby. I cannot wait to see that cluster. Yeah, keep going, boys. Keep going. All right, now, give you a few more minutes here. I want to run through this private credit stuff here for just a second. I've got a couple articles on auto industry, and then we'll wrap up for the night. So Blackstone caps withdrawals from flagship private credit fund. Blackstone's BCRED is among the latest private market funds to cap second quarter withdrawals after a wave of large redemption requests hit the sector. What did I say was going to happen? I told you guys a month ago, I told you guys this was the next thing that was coming. I told you that all these big players were going to cap, because all the money coming out, they can't let all this money flow out the door. It was only a matter of time. And the next thing that will happen is the customer revolt, okay? The absolute customer revolt, as these things continue to go down and customers continue to lose their money. You're going to see a lot of pissed off customers coming in to basically say, I want my money back. Blackstone is restricting withdrawals from its flagship private credit fund as a growing number of private market managers brace for a surge in redemption requests. The Manhattan-based private capital giant said on Thursday that it would limit investor withdrawals from the $79 billion Blackstone private credit fund, known as BCRED, to 5% of outstanding shares after redemption requests reached 10% during the second quarter. So yes, so again, you could expect to see more of this, not only with Blackstone, but you'll see BlackRock, you'll see KKR. Well, KKR is basically already doing it, but you're going to see other companies jump in. The anything goes era in private credit lending is coming to an end. Under pressure from investors, lenders are increasing costs and curbing sweeteners they use to win loans in an era of ultra competition. So the era of anything goes in private credit underwriting is coming to an end. Private credit firms are tightening their lending standards, increasing interest rates and other fees they charge on new loans, restraining how much debt they give borrowers, and closing loopholes that allow financing to be taken out against borrowers' assets. Executives and lawyers say standards began shifting around March and have intensified since then. Fund managers say they are seeing more risk of loan losses in the market. They are also dealing with the repercussions of increased scrutiny from their investors, which have reduced the amount of money private credit firms have to put to work. Yes, the flow of money going into these funds has dramatically slowed. For months, individual investors have worried about potential risks in the underlying loans made by private credit and responded by pulling billions of dollars out of private credit funds. Executives in the industry say that is an overreaction. Okay. And they are moving to share more information and calm the jitters. All right. Um, let's see here. And then we go to Fed sharpens focus on banks' private credit exposure. The central bank has begun collecting data from banks to get a better idea of how their funding is being used in private credit. Mickey Bowman, the Fed's vice chair for supervision, told lawmakers. So the Federal Reserve has launched a new data collection effort intended to provide more transparency on banks lending to the private credit sector. The central bank's vice chairman for supervision, Mickey Bowman, said Thursday. Bowman, who was among several regulators to testify Thursday to the House Financial Services Committee, noted the data collection as some lawmakers expressed concern over a lack of information on banks' exposure to the private credit market. Richie Torres asked Bowman whether an April letter to the Fed sent to U.S. banks inquiring about their financial exposure to private credit was an admission that the Federal Reserve has insufficient visibility into the full extent of the issue. Rep. Juan Vargas expressed concerns about the interconnectedness between private credit and the rest of the financial system and the gap in data that surrounds it. Bowman said a number of opacities exist between bank involvement and where funding ends up in the non-bank space. Yeah, I think these are great questions, and these are all concerns that I have brought up. I think there is a lot of issues in private credit. Just as Jamie Dimon said, there's a lot of cockroaches there. You put the light on it, you're going to find a lot more cockroaches running around. Okay, then let's get into a couple of these auto industry related articles here for just a minute. So 1 million new car buyers are gone. They're gone. And they're not coming back anytime soon. So high gas prices, rising interest rates, and stubborn inflation are keeping buyers at home and cars on the lots. So the U.S. auto industry faces sobering new math. Some 1 million prospective buyers have defected from the new car market since the start of the decade, and they aren't expected back soon. Until recently, auto executives, analysts, and economists believed that U.S. new car sales were on a steady climb back to volumes last seen before the pandemic closed factories and scrambled global supply chains. That is no longer the case. GM, Ford, Toyota, and other automakers have said they are planning for sales of new cars to shrink or stagnate this year after consumers, stung by persistent inflation, rising fuel prices, and high interest rates, are balking at prices that have risen to around $50,000 on average. Yeah, $50,000 on average, with most cars and trucks being $70,000, $80,000, $90,000, $100,000. Like, I mean, it is ridiculous. It is ridiculously insane how expensive cars and vehicles have gotten. Americans are buying around 17 million cars and trucks a year before 2020. Industry analysts don't expect the market to return to that level until the end of the decade or later. They now forecast total annual sales of about 16 million vehicles or fewer this year, and that outlook has grown even dimmer as the conflict in Iran keeps gas prices higher. This is a real threat to the whole industry. It's a proof point of something more fundamental, which is wrong in the general economy, that people are not able to buy new cars. Yeah, no, you know what, Sherlock. All right, and then we go to more monthly auto loan payments are above $1,000, and most are not for luxury models. Yes. Experian Automotive Analysis of more than 5 million open auto loans and leases in the first quarter shows nearly 19% of new vehicle loans include a monthly payment of at least $1,000. Almost 74% of the auto loans required owners to pay $1,000 or more every month for the non-luxury models. The top 5 models for the 1,000 plus payments were popular pickup trucks, including the Ford F-150, the Chevy Silverado 1500, and the Ram 1500, according to Experian. Yes. So again, this is, I mean, anybody knows this. You go to a lot. The cheapest truck you're going to find there is probably 70 something $1,000. Okay. The most expensive truck is going to be well over $100,000. You get the Ford F-150, I don't know, super cab, whatever, off-road super cab edition, probably going to be 115 grand. It's just, I mean, it's insane. And then we go to this. Americans are keeping their cars longer than ever. No doubt. And remaking the auto industry. Automakers, dealers, and repair shops are changing business practices to adapt to the new normal, the 13-year-old car. Timothy Mason drives a pair of Honda Accords. One is a 2010 model with fewer than 40,000 miles that he uses for his daily commute in Massachusetts to his accounting job. The other, a 2001 V6 with more than 280,000 miles he uses for tough winter driving. Where's the financial sense in a new car? Mason 41 said. Better fuel mileage, maybe, but is it going to save me $800 plus? Is it going to save me $800 plus per month? Mason is on the extreme side of something happening across the country. Americans' cars are older than ever. Some drivers are squeezing more miles out of their vehicles and eschewing new rides because of sticker shock, high interest rates, and economic jitters. Others are hanging on to aging wheels simply because they can. Thanks to advancements in engineering, materials, and safety technology, today's cars last longer than vehicles of generations past. Yes, that's true, but people are also just keeping them rolling out of necessity. The average vehicle on the U.S. road is about 13 years old, a historic high and a 10% jump from a decade ago. And basically, auto dealerships are, I mean, they're changing the way that they do things. I mean, they're really going to more of a service model. Because again, what the article we just looked at, the number of new cars they're selling is going to decrease. It's going to go down. So how do you make up that money? Well, you're going to make it up by servicing all these older cars. And then, another thing to consider, you've got the kill switch, or not the kill switch, which by law has to be put on all new cars starting next year in 2027. All new cars are going to have this kill switch on it. I think that alone is going to send the demand for older cars through the roof. Used cars are going to become super valuable. They're going to go there because people are not going to want these kill switches on their cars. They're flat out. They're just not going to want them. And I hope that somewhere along the line we get some kind of legislative action to kill this, because it's a horrible idea and it never should have been put in the first place. It's a massive government overreach and it should be shot down. But we'll see. But again, I think that is just something else that's going to add to this problem. But the bigger problem here is that the auto industry, they need to bring the prices of these vehicles down. They need to dramatically bring the cost down. If you're telling me that, like, I can't buy a decent four-door sedan, a new four-door sedan for probably less than $40,000, like, come on, man, really? It's just that they have to do something. They have to figure out something. And and I'll say this, it was fascinating to me. Going back to 07, 08, and 09, I remember when the financial crisis hit. And I remember thinking to myself, I went to, I'm not far from Philadelphia. And I haven't gone in many years, but I used to like to go down to the Philadelphia Auto Show. It's a massive auto show they do in Philly, one of the biggest auto shows on the East Coast. I used to love to go down to that every year. I went probably for, 15 years in a row, went every single year, loved going to the auto show, loved checking out all the new cars and all that. And after 08 and 09, as we got into like 09, 010, 011, I sat there and I said to myself, oh, this is probably going to be a great time to buy a car, right? Because the economy's in the toilet. GM, Ford, Chrysler at the time, which is now Stellantis, they all had to get bailed out by the government. And I'm thinking, oh yeah, they're probably going to reduce their prices because they need to sell a lot more cars, right? And no, 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 their prices just continue to go up and up and up. And I'm sitting there looking at this and I'm going, this just makes no sense. Like how, and yet somehow, people, just kept buying, just kept buying. But it was the craziest thing to me that I was sitting there and I was going, I just don't get it. How are their prices just continuing to go up and up and up and up and up? And I think we have finally reached a breaking point. I really have, because it's not just the fact that cars are costing $1,000. It's that they have to finance the vehicles longer. Like first it was people would only finance cars for 3 years. Then it went to 5 years. Then it went to 6. Now we're talking about 7 or 8 years. It was funny. Or I started the night by talking about the real estate industry and talking about the prospects of a 50-year mortgage. But now we're also looking at car loans of 7 and 8 years. People don't want to they don't want to keep their cars for 7, 8 years. People like to keep a car for 3 or 4 years and then trade it in and get something else. Like, I mean, it's again, we are going the wrong direction, and pushing the finance terms out to infinity is not the answer. That's not the answer. The cost of stuff needs to come down. It needs to come down. That's the answer. But how do you do that? And how do you do that in a way that's not painful to the everyday person? Interesting dilemmas there. And then finally, last article, I'll leave everybody with this tonight. Russia just passed a law allowing its central bank to down drones. That's awesome. Comrade, if we are getting hit with drones, we must blow them up. We must shoot them out of the sky. Have at it. Okay. Gotta love it, man. Thought that was good. I thought that was a good way to end the night here. So, all right. Now I'm going to go into wrap up mode. I'm going to give you guys the story of the week and the quote of the week. I'm just going to sorry guys, I messed that up. I hit I hit the wrong button by accident. I severely apologize for that. All right. Let's get over here. What am I looking for here? Okay. I need my banners. Hold on a second. Oh, I gotta grab my banners here. Okay. All right. So if you are watching, or I should say listening, if you're listening to the podcast on Apple Podcasts or Spotify, please make sure to leave me some reviews. That would really, really help the channel. Please leave some reviews out there on Apple Podcasts and Spotify. Please make sure to visit thebankernextdoor.com. Got a lot of great things up on the website. If you want the latest and greatest news announcements, anything I might be working on, episodes coming out for the week, what's going on, what we're going to be covering in Strategy Room, live stream for the week, make sure to subscribe on YouTube, because I put all those posts out on YouTube. So if you want the latest and greatest news, make sure to go there and subscribe. If you want to reach me, you can reach me at info@thebankernextdoor.com. That is how you ask questions, you send comments. If you have any topic recommendations, anything out there you'd like me to cover, make sure to reach me at info@thebankernextdoor.com. You can also follow me on social media. I am up on Getter, X, and Truth Social. I will tell you I spend the most of my time on X, but feel free to follow me on those platforms. And remember, BND Strategy Room is up on YouTube, Rumble, and all major podcast platforms. We put up new episodes every week, Monday through Friday at noon. And the BND Strategy Room is every Saturday night here on YouTube at 8 p.m. and soon coming to other platforms. I know I've been saying that for literally like a year, but it is going to happen magically one of these days. It's going to happen. All right, now let's go to our story of the week, shall we? So, May 26th, 1667, mathematician Abraham de Moivre was born in France, and de Moivre discovered the normal statistical distribution, also known as the bell curve. And he worked out the formula for standard deviation or short term volatility. He also published one of the earliest intelligent definitions of financial risk, which read: the risk of losing any sum is the reverse of expectation, and the true measure of it is the product of the sum being adventured multiplied by the probability of the loss. So, again, that was Abraham de Moivre. Who was from France, a mathematician, on May 26, 1667, basically discovered the normal statistical distribution, what we call today as the bell curve. So there you go. Story of the week. And now let's go to our quote of the week here. So this comes to us from Dale Carnegie. You make more friends in 2 months by becoming interested in other people than you can in 2 years by trying to get other people interested in you. Yes, if you have never read Dale Carnegie's classic book, How to Win Friends and Influence People, it is an absolute must read. Anybody who is in, forget finance or banking, if you're in the business world, period, you need to read Dale Carnegie's How to Win Friends and Influence People. And what he just said right there, you can make more friends in 2 months by becoming interested in other people than you can by trying to get other people interested in you. So yes, and that is absolutely 100% true. Love that quote. So now I just, to wrap up, I just wanted to give a final congratulations to all of the 2026 Stonier graduates. The ABA Stonier Graduate School of Banking finished up, wrapped this week on Thursday, June 4th. Congratulations to all of the graduates out there. They all did an amazing job completing all of their capstone presentations and capstone projects. Just another great year at Stonier. So happy for all those students out there. Stonier is an amazing program. Anybody in the banking industry, if you don't know what Stonier is or is unfamiliar with it, just go Google ABA for American Bankers Association, ABA Stonier Graduate School of Banking. I am actually a graduate of Stonier. I've been a teacher there for the last 12 years, and I actually did an episode with the head of curriculum development, Greg Smith, probably about a year and a half ago now. But you can go check out that episode where we talk all about the Stonier program, all of the good, great things, all the great benefits and everything you get from Stonier and all that. So, but again, congratulations to the 2026 graduates. Very looking forward to another great year this year, as our calendar year will kick over again in August. And definitely looking for another great year of working with another crop of year 1 and year 2 students. And, going into 2027, I'm sure will be fantastic. So again, congrats to all of you guys out there. So with that being said, thank you so much for joining me here in the Strategy Room on this Saturday night. I hope everyone has a great weekend out there. Enjoy the week. I'll be back. I will see everyone again real soon. Next week, we will be back in the Strategy Room Saturday night, 8 o'clock here on YouTube. Thank you so much. Have a great weekend out there, everybody. And I will see you